In terms of supports, it should not break the recent low of 22,224.
BAT is looking to sell 4% stake in ITC, and I understand that the block will get launched early this week.
As flat as it can be, 4 odd points in the Nifty, Sensex about 17, 18 points.
The entire outperformance, right, can be termed as speculative in any manner.
There is a buoyancy in the market as a result of the elections as well.
It's a very volatile day for the market so far. It's been a topsy-turvy first couple of hours.
Aditya Birla Sun Life AMC, the recently listed or more newer listing from the Aditya Birla Group that is looking at the promoter selling down stake.
The BJP government has been able to implement it through a formal notification.
The Nifty, that one is up 67 points. There's some recovery from the lows.
Well, some recovery from the lows, but some selling from the highs as well now. In the last 20 minutes or so, there's only about 10 points on the Nifty left. And this was different 15 minutes back. So a bit of come off is what we are seeing. This is Closing Bell. We'll track markets for you over the next 1 hour. We're coming to you from the CNBC-TV18 News studios. I'm Prashant. With me, my colleagues Rima and Surabhi here. And of course, Nigel is joining us from the newsroom floor. Guys, hi. Afternoon.
Hi, afternoon. The selling in mid-caps, small caps continues.
Oh, absolutely. That's
Same story like yesterday. I mean, looking at the small cap index is down almost 2%. The micro cap index is down almost 2.5%. So I think this broader market issue not quite out of the woods.
I told you, the green was not an indication of where the market's headed in the morning, what we were discussing. But, you know, that is the story, right? But just a couple of points before we really get into it and tell you what's going on. So we've got, and sort of I wrote this down 10 minutes back, but it broadly still holds. Weak broader market, very weak broader market, but Nifty and Bank Nifty are holding. You know, they're not up or anything in any major fashion, but they're not down like what the broader market is doing. On the Nifty Bank, because we've had such a big swing, the low today becomes a bit important. 46,884 is that number. Bank Nifty is also absolutely flat right now. But the low is 46,884 would be good, nice if that holds. 5:1 declines outnumber advances, so it's pretty sort of poor market breadth out there. Small cap index is down 1.5, and now, I mean, we are talking double-digit cuts from the highs. 10% on the Nifty's small cap index from the highs that we saw back in February. And of course, PSU is something we highlighted right in the morning, that the index is showing signs of some negative divergence. And I think if you look at it, the PSU space is seeing a little bit of profit booking. The PSU Bank Index especially is the one which is taking it a little hard. 2.5% lower on that index as well. Rima.
Hi, it's the broader markets and the sell-off there, which is very concerning. The mid-cap index is down 1.5%. But the good thing is, perhaps in a way, that from 12 o'clock, it's still holding on to that 1.5% loss. The sell-off took place in the first, 2.5 hours, 3 hours of trade. And after that, it's been holding on, nursing those losses of 1.5%. The small cap index is down nearly 2%. The Nifty micro cap 250 index is a cut of close to about 2.5%. The other indices which are weak, Prashant spoke about PSUs, PSU Banks. Realty is taking quite the brunt today. The real estate index is down nearly 4% now, and the metal index is up is down 1.5%. IT, though, is trying to fight for the bulls today.
Yeah, absolutely. IT, I think, has been the only slightly more steady part of the market where we've seen at least some consistent green. The Nifty Bank has had a 930-point swing nearabouts today from the lows to the highs, and then it's really all over the place. Been very difficult perhaps for traders to trade that index today. Let's see what it does in the last 1 hour. On the broader market sell-off, just want to highlight a couple of stocks that illustrate how this is happening. It's across the board really. You've got something like a Patanjali Foods that's losing about 6%. Keynes Technologies, a lot of the EMS stocks that have been so well loved and well received by the market. There is a lot of profit taking going on today, about 8% down on Keynes. Godfrey Phillips is down about 9-10%. You have stocks pretty much cutting across all sectoral lines. By the way, GTL Industries is down about 10%. So the cut that started yesterday has only gotten a little more deeper. Today's listings, RK Swami, very, very tepid start. I guess market sentiment has a lot to do with it as well. RK Swami is down about 7% as we start things off. So, Nigel, hard to say, where this ends. But as of now, I think a lot of that sort of froth, so to speak, that the SEBI chairman also spoke of, that seems to be coming off.
Well, that's right. And the batsman that's standing in there today, as all the wickets are falling around, is HDFC Bank. If it wasn't for HDFC Bank, I'll tell you what, we would have been down by another 30-40 points approximately, because that's virtually at the high point of the day, with a gain of close to around 2.5%. There was a global index rejig, that had some pending flows. And Nuvama had said that it's likely to take place by the end of the second week of March, which should be by the end of this week. So I guess that is one part of the reason why we're seeing some bit of support coming for HDFC Bank. Actually, you just pull up a contribution chart. You'll see the reason that I'm talking about HDFC Bank, and Reliance Industries is also up more than 0.5%. So both those two big boys, you're talking about 20 to 23% of the index that are holding well in the green. And that's what's helping the bulls, at least for now. But big pain in the broader markets. How do you position yourself, though, in the final hour of trade? We have, I think, Mitesh, who's back with us. Hi, Mitesh. Well, it's been that sort of a day, right? On the index, not too gruesome. And it's giving you the sense if you buy the dip, it's okay. It's in that bit of a range. It's not falling apart. How would you trade the index at around this 22,300 odd mark?
Good afternoon, Ajit. So I think, what has happened is that we had some kind of negative crossovers on a lot of indicators on the intraday charts yesterday. And then in the first hour, which is still about 10:15, we had a very strong rally. But that's been sold into. I think slowly the picture is weakening. And my sense is that this time, we might actually, if we go down towards 22,250, we might actually break that. And if that happens, I think good chance that we are looking at a test of 21,950 and then eventually even 21,800. So my sense of, looking at the indicators and the overall setup on the chart is slightly on the negative side. So therefore, I think, I would suggest people to refrain from taking long positions and look for shorting opportunities slowly, as whenever you can identify them. I think, take those kind of positions over there. That's the way, we'll approach the markets.
Okay, thank you very much for that. Let's move on now and talk about the pressure that we're seeing in the small caps. The small cap index has now seen a fall of close to about 10% from the intraday record, which was hit on the 8th of February. Now, what are the contributing factors for this fall? Which stocks have been the big losers and which ones have managed to buck the trend and rake in some gains? Hormus joins in with the details. Hormus.
What a month can do, right? From the small cap index that was making new highs one day after another is now seeing some extreme selling pressure, and the index is now down 10% from that record of 16,691 that it had made on the 8th of February. And since then, the index in absolute terms, the index is down over 1,500 points. Now, since then, only 14 stocks, if we take a look at the 100 constituents of the small cap index, only 14 of them are trading with gains since then, but some of them are trading with gains of even less than 1%, and 80 stocks are trading with losses. More than 80 stocks are trading with losses, and out of those 80, more than 80 to 85 stocks, over 35 of them are trading with losses in excess of 10%. The losses range from anywhere between 10% to as high as 30% for stocks like IIFL Finance. Now take a look at some of the biggest losers since that day, from when the index topped out. Look at SJVN, NBCC, Angel One, Suzlon, Phenolics Cables. All of them saw some stellar moves throughout 2023, and those stocks from the 8th of February are down in excess of 20%, almost 25% for the four names. Phenolics Cables is down 22%. But despite this correction, there are still stocks like SJVN and NBCC, they are still trading well above their historical averages. SJVN is now trading at 25.7 times FY25 earnings, which is still higher than its 5-year average of 21 times. Same is the case for NBCC, that is trading at 40 times compared to its 5-year average of 30 times. So it's still, it shows the kind of moves that we have seen in these stocks. And this was from when the index peaked. Now, if you take a look at these stocks on a standalone basis, they have seen a far bigger correction from them on a standalone basis itself, because SJVN made a peak of 170 rupees. That stock is down 33% from that peak. Same is the case with NBCC. That's down 33% as well. Angel One made a high of almost 4,000. Now it's back to 2,500. That is down 34% from the peak. And Suzlon, which made a high of 50 rupees recently, is down 24% from those peaks. And there is a specific sector that I want to highlight, is those high-flying railway PSUs that have seen a sharper correction as well. Stocks like IRFC, RVNL, IRCON and Realtel, most most of them had moves of 200 to 300% in 2023, and those stocks now are correcting anywhere between 25 to 30% from their peak. Multiple factors. There's some circular from the Amphi circular, the SEBI chairman also highlighting, saying that there is some froth in some segments in the small cap space. So the mid caps fairly okay, but the small caps are bearing the brunt of this correction. Back to you.
Oh yeah, and the micro caps even more. Got that, Hormaz. Thank you very much for putting out that interesting data for us. Well, let's get the conversation going. We have Sudeep Bandyopadhyay, Group Chairman of IndiTrade Capital, with us on the show this afternoon. Sudeep, thank you for joining in. I think the question that a lot of people will wonder, that while this so-called froth sort of, works its way out of the market, what should one be doing? Which are the stocks that are now providing perhaps a decent entry opportunity, and which are the ones that one should completely steer clear of? So let's take the question of PSUs, because they're falling and losing some ground. What would your approach be?
Well, Surbi, I think, some of these PSUs, really the valuation was, one was not able to justify the valuations. I think I'll talk about two sectors. One is defense, the other is railways. I think fantastic sectors. The government of India has put a lot of might behind both the sectors, and absolutely for right reasons. We have never ever seen the kind of work which is going on currently in the entire railway infrastructure side. We have never seen this kind of momentum in defense. Defense Make in India has made a big difference. But what had happened is that the prices of these companies in these sectors have gone up, with in complete disregard to the fundamentals. Based on some order wins and some projects getting sanctioned, I think the prices were taken up a bit irrationally. And at some point of time or the other, the correction was due. Correction is happening. And I think post-correction, some of these are excellent long-term bets for an investor. So I will talk about defense companies like the shipyard companies, whether it's a Mazgaon dock or it's a Cochin shipyard. After some correction, they will definitely be a fantastic buy for a long-term investor. So is defense electronics like Bharat Electronics. I think it's a fantastic company. Bit of correction, I think it should be in everybody's portfolio. As far as railways are concerned, I think the story is pretty much the same. If somebody picks up good, rail-related companies at a decent valuation, there is absolutely no way they can go wrong with the kind of work which is happening in Indian Railways currently. So whether it's the wagon manufacturing companies or the financing companies in the railway side, I think after some more correction, there will be decent bets for long term.
Okay, thank you very much for that. Now let's talk about ITC. That's one of the top Nifty losers following reports about a potential stake sale by British American Tobacco PLC, BAT. Sources have told CNBC-TV18 that the block deal could be launched as early as today evening. We actually have Mangalam tracking the entire pack of cigarette stocks for us and their performance. Mangalam.
Well, this supply overhang on ITC has actually caused the stock to underperform over the last 6 months or so. In fact, currently as well, the stock is over 20% away from its earlier record high hit, a little over 500 rupees on the stock itself. But what it has also done is it's allowed all the other cigarette players to perhaps catch up in terms of stock price movements as well. So if you just take a look at this year itself, ITC is down about 13%, VST Industries is up around 11%, but the rank outperformer has been Godfrey Phillips, up 66% at a fresh record high for that stock as well. What is it that has gotten VST Industries and Godfrey Phillips to outperform as against ITC? For VST Industries, the support came in from its largest shareholder, Radhakishan Damani, who bought additional 1.5% equity from a large trade from a lot of the domestic mutual funds in February, on February 1 itself. And for Godfrey Phillips, it has been a steady rise in market share. If you just take a look at the volumes of all the cigarette companies over the last 6 quarters or so, you would see Godfrey Phillips actually consistently outperforming the industry over the last 6 quarters. Case in point, Q3 FY23, where ITC had a volume growth of 15%. Godfrey did much better with a 22.8% volume growth. VST saw volume compression of 3%. Even at the start of this financial year, where ITC's volumes were up 9%, Godfrey did in step with about 8%, and we saw a decline of 7% from VST Industries. And the previous quarter, which went by, where ITC actually had a volume decline of 1%, Godfrey Phillips saw a volume growth of about 10.6%. And it's not just the cigarette business. Godfrey Phillips, post its third quarter, also said that they're ramping their retail business up, and they're also setting up a base kitchen in Faridabad to prepare ready-to-eat meals, and also working on the confectionery business. As per PhillipCap, the triggers that or the reasons why Godfrey has been gaining market share is largely because, one, they've expanded the distribution of Marlboro Compact, which is a 10 rupee per stick cigarette, from just a few parts of the country to pan-India. And secondly, the recent launch that they've done of Stellar Shift Duos at 12 rupees per stick has also garnered favorable consumer response. With all of this, the outperformance of Godfrey Phillips and VST Industries versus ITC, where do the valuations stand? Well, ITC still at a premium at 21 times, but the premium as compared to the others has narrowed. Godfrey Phillips is at 19 times and VST Industries at 16 times 2-year forward earnings.
All right, Mangalam, thanks very much for that. That's the news coming in on Godfrey, and a nice explainer on what's going on in that particular space. There was a news flash, unfortunate incident. Air Force plane is met with an accident in Jaisalmer. That was a news which was flashing. We don't have much further details, but this is coming in from ANI. An Indian Air Force aircraft is met with an accident in Jaisalmer. That's all that we have. So awaiting more details as and when we get it. Sudeep is with us. Sudeep, good afternoon. Just wanted your thoughts on two names actually, both capital market plays. One is BSE, stocks down about 6%. We got information earlier today that NSE has cut some transaction charges. And the other one is Angel Broking. Angel Broking, from its high of, I think, nearly 4,000 rupees, is down to about 2,500. It's one of the top losers in this small cap correction that we've seen, broader market correction that we've seen. So just wanted your thoughts, Sudeep.
Prashant, as far as Angel is concerned, I always preferred Motilal Oswal amongst the listed, securities or capital market stocks. Motilal Oswal had a lot of verticals which cushions them from vagaries of the market, whereas Angel One was a one single line business, which is the equity broking predominantly. They are trying to get into wealth and other segments, and they are planning to raise money to get into multiple segments at this stage. But the fact remains that as things stand today, they are a single segment company, and the valuation was looking definitely rich at those levels, 4,000 kind of levels. So with all this, they talk about fraud, the AMFI coming in, the SEBI chairman talking about the fraud in the small and micro cap shares, as well as the stress test results, which are expected to come on Friday. I think there is a bit of nervousness, and some amount of profit booking is definitely happening in that counter. So I'm not surprised with the correction in Angel One. I would wait and watch that space. I think it's a good business they have built, but they have to do multiple more things to really command the kind of valuation that they reached in between. As far as BSE is concerned, I continue to remain positive. The valuation was looking extremely rich, and this NSE reducing some charges probably is an excuse for the market to do some profit booking, exit some positions. But fundamentally, it's a good place to be in. And for a long-term investor, I don't see any problem in remaining invested in BSE or even entering BSE at current levels.
Okay, all right. Hi, Sudeep. Good afternoon. Good to see you. When we had a flash that was up for our viewers on the screen where Ambuja Cements is saying that they could be selling close to 2% to comply with the minimum public shareholding norms. And Sanghi Industries, that's popped up close to 9%. Not too sure how it makes such a big difference because, just now they finished their open offer, but liquidity as is very less in Sanghi Industries. What's your view on Midcap Cement or Sanghi Industries in particular? The stock used to be a 30-40 rupee stock. It got a new promoter, then it ran up to around 140, and now it's around the 105 odd mark.
Well, I think this disinvestment is mandatory because they have exceeded that 75% shareholding limit. So public shareholding limit has to be adhered to. So that's why they need to disinvest that. So I think that's just an arrangement and just a structure they have to necessarily follow. But fundamentally, I think I have been positive on cement for some time, and I maintain my view. As far as mid-cap cement is concerned, one has to be company specific, predominantly because of the fact that cement performance depends on the region where they are located and where their catchment area is. There are certain segments or certain parts of the country where there is the demand-supply gap is still there, and the cement manufacturers command a better pricing power. And I think the mid-cap cement companies in those geographies will continue to do well. That's my belief. So as far as these companies are concerned, I like Birla Corp quite a bit, and I think that's one company one should look at. Apart from that, I think one can look at Heidelberg Cement as well. The geography in which these two companies operate are likely to have that pricing advantage as and when things look up.
Okay, got that. Sudeep, just a quick question on what we are seeing across the rest of the FMCG pack. I mean, Mangalam, of course, mentioned what is happening on some of the cigarette stocks, but we're seeing a lot of pressure on other names as well, whether it is Nestle along with ITC, Britannia. I mean, this has anyway been an underperforming part of the market. Given the volatility and given the sort of slight correction that we are in the midst of right now, would you look at adding anything to the portfolio from the FMCG space, traditional defensive area?
So I've been, positive on FMCG for some time, and I've been proven wrong for some months now. But I believe that the rural demand pickup is bound to happen. I'm actually surprised that it hasn't yet happened. The government definitely is trying, and a lot of schemes, a lot of offers, a lot of benefits are now going to rural India. With monsoon likely to be good, that's what the predictions are. I believe that rural demand will be back. And if the rural demand picks up, I think the companies which will benefit the most are the companies which have maximum exposure and sales coming from rural India. HUL is obviously the biggest company there. The second company which I would like to mention is Dabur. I think both HUL and Dabur will benefit the most when rural consumption starts picking up. Undoubtedly, FMCG companies should be looked at this stage when the market is down and FMCG is kind of being avoided by most players. So this is the time to probably start accumulating some of these rural-focused FMCG stocks.
Okay, all right. Sudeep, we'll leave it there for today. As always, interesting chat, good chat. Thank you for your time here on CNBC TV18. You got the market which is blinking red and green, absolutely flat, right? I mean, 0.5, 1 point change. That's what you've got in the Nifty. 22,331 is where what we have. And I mean, of course, broader market is a different story. 5:1 declines outnumber advances, as we've been pointing out, and there is no let up there. We'll take our first break here on Closing Bell. We are back. Sanjay Parekh, founder and chief investment officer at Soham Asset Managers, will be with us on the other side. We'll touch upon many more stocks as well with our research analysts. Stay with us.
Welcome back. Aditya Birla Capital is surging after the board approved a merger of its wholly owned subsidiary Aditya Birla Finance with itself. Ritu joins in with the details and what brokerages have to say on this development. Ritu.
That's right. The board of Aditya Birla Capital has approved the amalgamation of the wholly owned subsidiary it has, which is Aditya Birla Finance, with itself, and that will create one unified NBFC that will then, more importantly, be in compliance with RBI scale-based regulations, which required that Aditya Birla Finance get publicly listed no later than September next year. So this is actually coming in a good 18 months ahead of that deadline. Of course, this is going to be subject to various approvals from NCLT, RBI, SEBI, etc. Now, after this merger, the listed entity, which is Aditya Birla Capital, is going to get converted from being a holding company to an operating NBFC. Vishakha Molye will then assume the role of MD and CEO of this merged entity. Now, the company says that this move is going to help it achieve a more simplified structure, a more optimal and efficient utilization of capital, and consolidation of the business, which it says will result in longer-term growth. As far as brokerages are concerned, Morgan Stanley has maintained an equal weight call with the target price of 196 per share. It says tangible economic benefits are not very material from this, but it will lower the holding company discount. Jefferies is more bullish. It has raised the target price to 225 a share with a buy call. It says the move will simplify the structure and lift the capital adequacy ratio by about 150 basis points. Of course, the stake in Aditya Birla Sun Life Insurance, which is currently at 51%, will have to be pared down to comply with the 50% cap on holding. But key to note, apart from all of this, is that Aditya Birla, yes, it's going to be compliant with the upper layer NBFC listing rules because of this move, but the focus will now shift on Tata Sons, which also falls in the same category and is said to be weighing its options to comply with RBI directions without necessarily getting listed. Of course, the final word is going to be with RBI.
Okay, all right, got that. Ritu, thank you very much for the details there. Yes, indeed, Aditya Birla Capital has been in focus all day because of those developments. Let's also talk about Cipla now. Cipla is actually the biggest loser on the index today. It's been trading under pressure, falling about 2%. And the concern is on supply disruptions, perhaps impacting the company's FY25 estimates. Ekta is here with more details. Ekta, what are you picking up?
Well, yes, it is a Phillip Capital report which has indicated, as per Exim data that they have, that Cipla's export of albuterol, which is one of the inhaler drugs that they've been selling in the US markets from the Indore facility, seems to have stopped. Now, this is since it received a US FDA warning letter in November 2023 for the plant. Remember that albuterol is around a $140 million opportunity for Cipla for FY25. Now, according to Phillip Capital, if in case the supply disruption continues, it could have a negative impact to the tune of the following for FY25, 4% on revenue, 10% on EBITDA, 12% on profit. They expect earnings risk to Q4 as Q3 seasonality benefits will taper off as well. They don't expect any major near-term earnings trigger. This is as the launch date of key products such as Advair generic and Brexon generic have gotten delayed, and the earnings concentration risk of Revlimid as well as albuterol, along with a delay in key drugs, keeps them pessimistic. Remember, they have a sell call. They've reiterated their sell with a target price of 1150.
Okay. Ekta, thanks very much for that. Sanjay Parekh is now with us. He's founder and chief investment officer at Soham Asset Managers. Sanjay, good afternoon. Great to have you with us here as always. And, interesting time to be speaking with you because, as of today, as of now, the small cap index is down about 10% from the highs, from the recent highs. So, talking to you, someone who's a stock picker, I just wanted to ask whether, anything has caught your eye, which you wanted to buy and which is kind of corrected. Many have come off 15, 20, 25%. So, it's an open-ended question. So, do answer that. And I wanted your specific thoughts on Angel one. That caught my eye. That's lost about 25% of its value from the highs. I'm not sure if there is some other fear because, you're hearing warnings from the regulator in terms of the froth, etc. Could it be possible that on things like, the margin trading facility, which brokers offer, which has been highly profitable, the book has grown quite a bit. Could there be some restrictions? I mean, I'm just sort of thinking out loud here. Just your thoughts on that one. But first start with what you noticed. Go on.
Yeah, Prashant, good afternoon. So basically, ours is a large cap fund dominated by large cap. And we have middle and small cap, but we buy them if we feel the divergence is high. As of now, we are 84% into large cap. We moved from 77% to 84%. And that is because we were seeing froth in mid and small caps. So we really did not find a lot of value in the last 2-3 months. And of course, we use a bottom-up approach. If it falls within our filter, we would look positively. But we believe still, it's still there's a lot of froth. If you take the Bloomberg consensus estimates for mid-cap, it's 26 times 1 year forward. Small cap index is not representative because the stocks you don't like are really cheap, but the rest of them are at 25 to 30 times, somewhere 35, 40 times. And we all know that flows, the flows doing its wonders on valuations, be it AIF, PMS or mutual funds. So I think there is still a lot of froth. One has to be very selective. This could be, it doesn't end. In small and mid caps, reactions don't end so soon. So I think one has to be careful. And one has to be really on a stock basis. If there is, of course, something that you like, you have to buy them. But I think we are still far off from those levels where we would want to buy in mid and small caps. On Angel, of course, we used to own it, and now we have sold it because we didn't find it very cheap at 35, 3600. I think it's a great franchise now, reacted quite well at around 20,000 crore market cap. It's going to raise 2,000 crore. Mainly, they've stated that is because they would have to, the whole margin funding route, wherein earlier, clients' money could have been used is now not possible, and hence they would need some working capital. And that's where they've not stated any potential acquisitions that they want to do. But that is what the stated, policy from their side. So now, of course, market view is very important because very large part of their profits pool is from derivatives. So, and then, of course, if there is any regulatory change there, we'll have to watch closely because there has been earlier indications by SEBI saying that, almost 95, 97% people don't make money. And all that stuff. So we have to be watchful, but I don't think there could be any major clampdown there. It's a great franchise with profits which could be around 1150 crores this year, 1300 crores next year, and then it could even further increase 13 to 1400 crores. Of course, it depends on markets. So it's pretty reasonable now, and we certainly will watch it again to look to add. But having said that, broadly, we don't see any regulatory change coming into Angel from a SEBI perspective on the derivatives, which is a large profit pool for them.
Okay, all right. Hi, Sanjay. Good afternoon, Nigel on this side. I recall our last conversation. You said it makes sense to go overweight on HDFC Bank. Till then, till a month or so ago, you all were actually underweight on HDFC Bank. You all had higher exposure to other banks, SBI Bank, a couple of other banking names as well. Have you all gone full throttle on HDFC Bank now in the last 1 month or so? And do you still maintain that? And since earlier you all were overweight on SBI in comparison to HDFC Bank, at current reckoning, what is the choice?
Yeah, so SBI still is a very large overweight. We are around 7%. Till last December, for almost 9 months, it did not give us results. But you saw we're just seeing the first year to date, index was up 3% and SBI has done some 20%. So that's what it is. It's always non-linear. It was very, very attractive. It still is attractive. And we would want to hold on to our exposure in SBI. Because today also at current levels, I think it's 1.1 time FY26 and 1.35 times 25, which is very reasonable for ROEs of 18 to 20% and ROA of 1%. HDFC Bank, we marginally increased our weight, and in our PMS, we have further increased. We genuinely believe, that a lot of negatives which are in the near term are, they're all in the price. We will see some more some more consolidation in terms of, because the whole merger was pretty large. So the whole liability side, slowly, the growth has to be there, and asset side growth will be reduced and NIMs would go up. But they have a very strong cost lever, and I very confidently feel that, if the earnings growth expectations are reasonable, they will be met. So I think it's very, very attractive on valuation. It could take 1 quarter or so, but from a price perspective, I think it is very little risk in HDFC Bank.
Okay, that is HDFC Bank. Overall, what's the sense, considering that we're in this phase where everyone's first of all second guessing when the next round of rate cuts happen, then we're running into an election season as well, and then you have all the regulatory scrutiny. So what is the strategy? I mean, just the near term, given the elevated levels the market is at, how are you looking at things?
Yeah, so, earlier also we had said that this year we're going to have mediocre returns and that will be back-ended. We are certainly, even on Nifty, we are not cheap, So, and as I said, the froth in mid and small cap is higher. But in Nifty also, if you take earnings of 1100 on and we give, India, I don't think we should go beyond 20 times for our interest rates. So, then you go to 22,000, that's where we are. And we have a whole 6 to 9 months ahead for 25. And then we look at 25, 26, and maybe, there broadly, we don't have visibility, but 1250 is a possible scenario, which is nominal GDP plus growth rate. So, we are moving faster, which is 3 to 6 months ahead and maybe 3 to 5% on price. And both can happen. And we have events now, politics is one where we know there's going to be continuity, but then we would have monsoons, geopolitical risk, even certain issues around water, we can't ignore. It's still small, but we need to watch how the administration is handling it. It's not in one area if it gets broad-based. So we have to watch all this. And that's why we believe that valuations are not cheap and we would have back-ended returns this year and that would be mediocre. That's our view, even in large cap. So mid and small cap for sure, we think that they can react further.
So since there is still a lot of froth in the mid and the small cap, would you look to up your large cap exposure? You've already increased it from 77% to 84%. Are you looking to raise it further by paring down your holding in mid and small caps? And as you did that in the last couple of months, what were the stocks in the sectors where you sold off some of your positions?
Yeah, so you'll always feel that yours will not fall, right? And you always have a bias. But what we've done is, and we got money, dramatically, almost 100% was into going into large caps. That too selectively. I don't think cash will hurt from this levels. If you have even a cash levels which we keep in the range of 0 to 10, I don't think it's going to hurt you. So, but we look for stocks at our comfort zone, and we've almost not added much in mid and small cap. In fact, we sold off, reduced broadly. As I told you, Angel Broking was one. Earlier, Jupiter Wagon. Before that, Sirma. And even we have trimmed in some of the exposure we have right now. So we have done that, and we would watch now for a better entry price in mid and small cap for sure. And in larger cap also, we are very selective given our stand on the markets that we have.
While we started with Angel one, but look at the other one, BSE, the exchange, sharp recovery, almost a 4% recovery is what we are seeing on BSE. The intraday will tell you what's going on. Look at that. It's down just about 2.5%. It was down 6% when we started. So that's a pretty sharp reversal coming in on a large liquid name, which is, of course, done exceptionally well. And on Angel, as Sanjay was pointing out, they do 1,400 crores. You're talking about the stock now trading at some 14 times earnings. After the 25% fall. But there is that QIP or that fundraise 2,000 crores, as you said, perhaps a bit of a overhang at this stage. The other one, Sanjay, you own is ABFRL, right?
Yeah.
And so it's like you're taking the opposite trade. Trend has done very well, ABFRL has done very poorly.
I'll be very adamant. It's perhaps, it's not done well for us. And it's just that sometimes you don't want to sell at any price. And here, these are the stocks that keeps us grounded because it's really one of the worst performers we hold. And, they have, of course, expanded And that is whole thing that the acquisition that they've done is taking time.
But will it, I mean, in your, because you must do a constant evaluation, is the thesis with which you bought not turning out to be the way you thought, or it's just taking longer?
It is taking longer, and it's not that we don't, I mean, we genuinely believe it could be taking a little more of time. They have size, critical mass, but the profitability is getting affected, and then you slow down as well. So certainly it's, otherwise we would sell it. I mean, we are fine to admit that we went wrong and we sell off. But this is one where we want to hold on for a while. We will be patient with them, and we'll see for another 6 to 9 months, where they get back to the profitability zone, better profitability zone, and then, the whole acquisitions they have done, organic, inorganic, all of it, whether they can consolidate well across the formats they have bought into. And that is where the street has less confidence. It's very, very reasonable now. I mean, it's almost like a commodity valuation if you look at even EV, EBITDA after rent. So it is reasonable. So that's where we want to hold on for a while, but it certainly underperformed compared to Trent or any other retail like Titan. It's significantly underperformed.
Okay, all right, Sanjay, you need to admit sometimes when you're doing that, go right sometimes, but make sure, your rights outweigh the wrongs. Thanks a lot for joining in, and thanks so much for giving us your take on a whole host of stocks that we discussed as well. Well, before we slip into a short break, Prashant was talking about some recovery in select stocks. Just want to point out a few of them. Suzlon has recovered a goodish bit. The stock was down close to 4% when we started off the show. So that's recovered. Zomato has now moved to the high point of the day. So keep an eye out on a couple of these stocks. But it's around 3 p.m. odd. So we'll slip into a short break. You come back. Nimish is waiting for us with D Street Chatter. We'll also give you some trading picks. Welcome back to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, it's that time of the day when Nimesh joins us. Nimesh, tell us, what are you picking up? A lot of pain in the broader markets. Suddenly people are talking more rationally. People are ready for that slow ride.
Yes.
And large caps are getting bulk of the share.
So again, not highly unexpected, right? We've been saying for the last few days that it's the broader market which is under pressure, and there are some technical factors as well. I spoke yesterday as well. Few reasons why. One, of course, the regulatory action which has taken place. Two, the SEBI chairperson herself said that she finds some bit of exuberance in some pockets of mid cap and small cap. Plus, we have the year-end adjustments as well. So all this is like coming together, and that's the key reason why the broader markets are under pressure. So the small cap index is down 2%, micro cap index is down to nearly 2.5%, and this in the last 4 days itself is down 4%, right? But again, it's part of the course for the fact that we've seen such a big rally in the broader markets in the last few months and years. So that's par for the course. But again, from a flow perspective, my sense is there is buy cap names. In fact, there's going to be a small MOC basket buying as well at a leading FIDs. So across Nifty names, I understand there is this buy flow. But again, while the screen is suggesting that there is pain in the broader markets, I spoke to some larger HNIs today just to get a dipstick survey. And the feedback is there is not big panic, so to speak. Okay. This looks like more of technical in nature. And the overall feedback is maybe, post 20th of March, you will see a bit of reversal as well, because the flows from the domestic mutual funds and flows into domestic mutual funds seems to be quite strong, right? So it looks like it's technical in nature that you're seeing pain in the broader markets and can get very soon. No need to panic as such, but again, now it'll be all about figuring right stocks in the broader markets, which is backed by fundamentals as well. So that's going to be a key for the outperformance in the broader markets from here on.
All right, so the regulators wrapping the knuckles, maybe that advanced tag phenomena as well, and maybe in the next few days, hopefully there'll be some kind of stability. Very important feedback, Ramesh. But what about individual stocks?
So in terms of individual names, the first stock on my list today is Adani Ports. Well, the stock is marginally under pressure today, but I understand there are very strong buy flows. The FI buying seems to have emerged in that stock of late, and today is the case as well. And also there were a couple of upgrades today from sell-side analysts on Adani Ports. So that's the first name. The second name is Nirlon. That's been consolidating around those 52-week high levels of late. But today there is a large block, 2.5% equity got changed hands. And I understand one of the large FI investor was a seller in today's blocks. The disclosures could be quite interesting there. The third name is SW Solar. That's been a relatively outperformer in this quarter. There was a QIP which was well bid by large institutions as well. Now I understand there's going to be a large block in SW Solar very soon, so that's something to track going forward. And the last name is Tilak Nagar Industries. Part of the course for the small caps to underperform. The stock is down 18% Y2D, but now at these levels, some bit of HNI interest seems to be back. And I understand there are strong buy flows from HNIs today, and some larger HNIs bought as well in this weakness in the last couple of days.
Thank you very much, Nimesh, for that interesting list. As always, let's now go across to Mitesh for a few BTST calls. Mitesh, what do you have for us?
So on the stock side, I think the index with all kind of choppiness has closed near the yesterday's close level. So nothing much has changed for me. So I maintain a slight marginally negative bias. But yet on stock side, I have a BTST and Lotus Labs with a stop at 410, and look for a target of 422. And on the PSU Banks side, SBI is an STBT with a stop at 765 for targets of 745.
Okay, all right, got that. Mitesh, thanks very much for the trades. Well, with that, we'll take a quick break, come back on the other side and get some technical perspective on the market. We'll have Jay Bala of Cash the Kiosk joining in. Welcome back. Well, still tracking losses, barring some of the large banks and some of the large IT counters. That's been the story of the day. Extremely jagged graph over there. 200 points, that's been the range, and the market's gone all over the place in that range. We've got Jay Bala of Cash the Chaos with us now. Jay, let's talk about the move that we've seen on in these two pockets, and these are the two strong pillars of the market, IT and private banks. Do you see the traces or the evidence of any sustained long trade on either of these, two pillars?
Hi, Shruti. Thanks for having me on the show. IT has come to an important support of 36,200, which I had pointed out a few times. It touched that intraday level, and then it's bounced back. But to me, the IT sector's movement is suspect, and I don't see sustainability there. If we see a break below 36,200 on a closing basis, then that will mark the start of weakness. But the trend change for the Nifty IT index comes below 34,200. When it comes to the private banks, it's actually slightly the reverse. The private banking sector bounced back to the 61.8 Fibonacci retracement of its decline from the all-time highs, and it's coming back lower. If the private banking sector were to drop below, say, I think 22,850, my memory recalls right, and that'll mark the beginning of the next leg of the down move for the private sector. So watch out for this. ICICI Bank is particularly looking vulnerable there.
What about PSU Banks, Jay? Good afternoon. You've got a 2.5% cut there as well.
Yeah, that's right. See, there are key pivotals that are trying to turn, and SBI is the bulwark over there. And if SBI were to close below 737, that will mark the end of the up move and start of a short-term correction. And Bank of Baroda within that space, even that's starting to look slightly shaky over there, although it's near all-time highs, but it's starting to look exhaustive there. And even other PSU names, most of the private sector enterprises stocks, they've all gone parabolic. So if it were to break the March-February low, I think that will also mark the start of a reversal in the medium term.
All right. Hi, Jay. Good afternoon. Good to see you in. But what about Reliance Industries? If you have to look for one solid batsman in a team, it has to be Reliance Industries, which has been in 5 form. What are the levels you're looking at on that one?
Yeah, Reliance is absolutely the crucial for the overall market. And as I've been saying for several weeks now, index managers have been using this as a prop for keeping the markets up. The critical level for Reliance comes in the zone of 2,900 to 2,840. If this zone were to get taken out, I think that will mark the end of the distribution. And we've seen the small caps break down below the 15,200 level that I mentioned last week, and the micro caps are for the first time after November are coming below the 50-day moving average, and they've closed below it for the last 4 sessions. So the broader markets is clearly signaling that it was a distribution, but wait for the large caps led by Reliance to close below 2840, then that will say that the larger correction is starting.
Any particular thoughts on ITC? We've seen the stock correct from levels of nearly 500 down to 400. Technically, what is the chart telling you?
Yeah, ITC, bullish in the medium to long term, but there is a short-term, price structure that's pending. If it were to break 400, I think this has potential drop to about 370 to 365. And as an extension, that is likely to cause an effect on the FMCG index. Actually, below 53,100 on the FMCG index, the FMCG index is likely to drop to about 50K. So that is already a setup that is visible for several weeks. It's just probably waiting for ITC to drop below 400, 395 mark.
Okay, that's a call coming in on ITC. Pharma has been relatively resilient, but I mean today even some of the larger pharma stocks are under pressure. Do you see any trades here on the pharma or the healthcare side?
Yeah, it's a bit late here, and I've been bullish on most of the pharma names since October, and I've been pointing to this as my favorite sector, and it's come to even exceeded much of my targets. it's still on an uptrend, but it's slowing down. If you want to look at something fresh, you might want to look at something like Dr. Reddy's or Arabindo. But these are all quite late trades. You might, if you are in the habit of pyramiding into your trades, then these might be ones. But otherwise, most of them are an avoid here.
Okay, most of them are an avoid. Any other specific trades you'd want to recommend, Ajay?
Yeah, I like Linde India. It's had a bullish breakout, and it's had a it's come out of a falling wedge pattern, and it's likely to scale somewhere close to 6,800, maybe even 7,000. So watch out for this. This is seeming to be a good breakout. A conservative stop of about 5,800, but an aggressive stop of about 6,000. And Apollo Tires, that it's looking like a good shot, provided it breaks 500. Subject to breaking 500. If you look at the Tocom rubber prices, the last couple of months, they've risen sharply to by 50%, and it doesn't look like an end of a move. It could even rise another 25% from current levels. So, that could bring negatives for most of the tire names. So this is looking at good trigger below 500. Stop loss is 543.
Okay, all right. Jay, we'll leave it on that note for today. Thank you very much for joining in. Let's go back and look at the screen. It's looking very similar to what we had going on yesterday. The pain in the broader market, that has not ended today. In fact, if anything, it's we've added to the cuts. Nifty is ending absolutely flat. The gyration is about 200 points on that index. The bank Nifty saw a swing of over 900 points, 950 points. It was really all over the place. The last men and women standing, so to speak, HDFC Bank on the upside, TCS, LTI, Mindtree, Infosys and Reliance. But you take out these 3-4 stocks, and I guess even on the large caps, the picture would have been very, very different.
Absolutely. We would have been down, and down by maybe not a very meaningful number, but yes, definitely 40, 50 points. Easy. So few kind of holdouts in an otherwise down and drifting kind of day, and that kind of a market as well. 5:1 is the advanced decline ratio. It's actually easier to count what was up. So let me actually do that. So you got, of course, Geo Financial, which was up 2%. Oracle Financial Services has had a fantastic 24 so far. Another 2%. Linde India, Jay was talking about that, 7% gain on Linde India. AB Capital started 5% higher, will end about 2% in the green. Torrent Power will end about 3.5% higher. There was HEG, 7% sharp move, almost 1,800. There was India Mart, which was up about 3% or so as well. Poonawalla FinCorp, Balakrishna Industries are some of the other. MGL, of course, which had a rough last week. MGL ends about 2% higher as well. This is the largest volume-led gainers list that we had today. Prima.
Well, in terms of the sectoral tilt, IT held up, the Nifty IT index ending with a gain of about 0.6%. And here the large cap movers were TCS and LTI Mindtree. Both of them were up close to about 1.7%. On the losing side, Realty took a big knock today. The Nifty Realty Index cracking close to about 3.5%. Metals too under pressure. The Nifty Metal Index down 1.8%. All in all, the Nifty and the Sensex end absolutely flat. Just down 2 points on the Nifty by the close, but the mid-cap, small-cap selling pressure continues unabated and a very bleak advanced decline ratio. We had one stock gaining for 6 stocks declining today. We're going to take a leave on closing bell. Thank you very much for watching, but do stay tuned. Markets Forward comes up next.